Hello, we are back with our Chapter 3 lecture. Chapter 3, Accrual Accounting and Income. We're going to start with our fourth learning objective in this lecture, which is to construct the financial statements. If you recall, in our previous lecture, we actually left off here. So let's start. In order to construct the financial statements, we have to now prepare an adjusted trial balance. The adjusted trial balance is the only format that you can use to prepare your financial statements. And also recall that we produce our income statement first, and you see our revenues, and this basically has revenues minus expenses to get to our net income. And as you see, our net income is $2,900. We took our service revenues, all of our expenses, we subtracted our taxes to get our net income. Then we go on to do our statement of retained earnings because, as you can see, our net income is needed for that. So this is in the form of a T account, right? If we have our retained earnings, that it has a credit balance. So we have beginning balance plus net income minus dividends gives us our ending balance. Now with that ending balance in retained earnings, as you can see here, we move that into our balance sheet, which is our third financial statement. And you know our balance. So basically each statement communicates with another. So from our statement of retained earnings, we get our ending balance of retained earnings. Notice that our balance sheet is in the accounting equation, right? Assets equal liabilities plus owner's equity. You see our total assets of $83,300 equals our total equity of $83,300. Now we have to close the books. So we've done our month end. So we basically started off with our month end. We did our adjusting journal entries. Then we prepared an adjusted trial balance. From that adjustment trial balance, we prepared our financial statements, income statement, our statement of retained earnings, our balance sheet, and our statement of cash flows. So now we're done with our month, so we close the books. So when you close the books, usually this is done at the end of the year, not the month, because you're closing your temporary accounts, which are your income statement accounts, into your permanent accounts, which is your balance sheet. So you do exactly the opposite. For example, in revenues, as you recall from our T account, it has a natural credit balance. So you're going to debit every revenue account and then credit retained earnings to move those accounts from revenue to retained earnings in the same credit. So normally revenues have a credit account, so we're going to just add those credits over into retained earnings by debiting the revenue account and then crediting retained earnings. You do the opposite for expenses. Expenses has a natural debit balance. So in this case, you're going to debit retained earnings and then credit each expense. Because remember, expenses reduce the owner's stake in the company. Now, dividends also has a natural debit balance because it is a contra equity account. So then we are going to credit dividends and we're going to debit retained earnings in the same fashion. So here we see the accounts that get closed. Dividends is the only one within that you would probably get confused with. Dividends are not an expense, so don't get that confused. They are a contra equity account, hence why the debit balance. And you see the rest of the temporary accounts, which are your income statement accounts that get closed at the end of the year. So here's an example of your journal entry. Basically, it's your income statement in an opposite format, right? So here we are debiting our revenues and we are crediting all of our expenses. We're also crediting our dividends. So we have our beginning balance in retained earnings. We take the revenues, we take all the expenses out, the dividends to get our ending balance. And this actually now shows your T accounts with the flow from the debits to the credits. So let's practice. Let's prepare the closing entries based on the information given below. So here we know service revenues are $63,800, so we're going to debit that. Our interest revenue, which is our next revenue account, we are actually going to debit. And our retained earnings account of $64,600. Because the debits and the credits must equal. Now we are actually going to do our cost of services for the 28, because that's an expense, cost of goods sold, our selling, general, and admin expenses as well, and our depreciation expense. All are expenses that get credited and we debit retained earnings, including income tax. Now we just need to close the dividends account. So in this case, dividends has a normal debit balance, so we're going to credit that and debit retained earnings. So how much net income did the company earn? You see the 64.6 for the revenues and then the expenses. So just a simple subtraction gets the $13,800. And then here's the retained earnings T account, which is basically your statement of retained earnings. And you see the net income here. So let's move our discussion on to cash. Cash is the most liquid asset. Liquidity mean how readily it can convert to cash. Well, cash is cash, so it is the most liquid. Then accounts receivable are also pretty liquid because you expect to get that money relatively quickly. Inventory, not as much. It might take you longer to sell that. And equipment and buildings are really not liquid at all because you normally don't sell them, right? You use them. Sometimes you do. So assets and liabilities, which are on our balance sheet, is it presented in the order of liquidity. So as you guess, cash would be first. Then we have current assets, long-term assets, current liabilities, and long-term liabilities. These are subclassifications to our balance sheet. And remember, our balance sheet is assets equal liabilities plus owner's equity, ALO for short. So current assets are usually converted within 12 months. So that's why they're considered current, because you're going to pretty much get them, convert them into cash. You're going to convert those assets into cash relatively quickly. Now, long-term assets are usually the tangible and intangible assets like property, plant, and equipment, and then intangible assets like copyrights, trademarks, etc. Current liabilities, similar to current assets, are usually if they're paid within the year, so that's why they're classified as current. Accounts payable is usually listed first, followed by notes payable, salaries, and then your unearned revenue. Remember, that is a liability. Then your long-term liabilities are basically anything greater than a year, and notes payable is usually part of that classification. So we have types of formats for both the balance sheet and the income statement. We have a report format and an account format for the balance sheet, and a single step and multi-step format for the income statement. So the balance sheet report format, you see, has a classification for current assets, and it has liabilities and all the other accounts. So the key here is that it has current assets. The balance sheet account format would look something like this in Excel. And the income statement single step format is simple. It just has one total for revenues and one total for expenses. Whereas the multi-step, we have several subtotals. Revenues minus cost of goods sold equals our gross profit. And then we have operating income. So we will do the various expenses such as, store and other operating expenses, depreciation. Then we add any gain on the sale of property or any income from investments to get operating income. Subtract interest, income, and expense to get income before taxes. Sometimes this is also referred to at EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Remember, depreciation is the usage of tangible assets. Amortization is the usage of intangible assets to finally get to our net income. Moving on now to our sixth learning objectives is where we're going to analyze the company's ability to pay debt. So net working capital is one of those formulas where you have current assets minus current liabilities. Make sure this is in your Excel spreadsheet. What net working capital tells us is the liquidity of the company. Do they have more current assets than current liabilities? Our current ratio, also a great formula to add into your Excel spreadsheet, is the total current assets, but now we are dividing that by our current liabilities. And here this tells us how well the company can pay its liabilities. And most companies like that range to be obviously greater than 1. You want your current assets to be larger than your current liabilities. So how do transactions affect ratios? So if you notice, we issue stock and received $50 million in cash. Well, that is basically, if we had just before these numbers, you add the 50, it increases our current ratio. Debt ratio is total liabilities divided by your total assets. And that indicates the portion of the company's assets that are actually not theirs and financed through debt. And this really measures how both their ability to pay not only the current assets, as we learned in the current ratio, but now the current liabilities. So a low debt ratio is safer. That means, right, we don't have more liabilities than assets, so we're able to pay those items that come up. Now, for a debt ratio, if when we issue stock, right, we have our total numbers, when we actually issue the common stock, then our ratio goes down slightly, as you can see.